Welcome back to the Dividend Diplomats YouTube channel. You've got your favorite boys here, guys. Bert, the Hurt, and Lanny, guys. Ho, ho, ho. The stock market, it's been pretty volatile, obviously, to say the least this year. But these three stocks have gotten their what's kicked year to date and over the last 52 weeks. So are these three stocks too low to ignore right now?
All right, smash that subscribe button. Everybody give this video a thumbs up. How are your boys, the Dividend Diplomats? Guys, are these stocks too cheap to ignore? Have these stocks that have gotten that sweet chin music, the Hogan leg drops, the Macho Man flying elbow off the top route, that Undertaker tombstone. But are they going to get back up? Is this the
Rest.
time to buy this before they? Yeah, let's go. Let's see, Lanny. How are we going to look at these stocks?
We're going to look at them. We're going to look through the DD stock screener, guys, focused on the PE ratio, payout ratio, dividend growth, and dividend yield. When you're looking at these stocks, you got to really have that long-term perspective here. And these could be short opportunities and what could be an overall long-term upward trajectory. And, again, we've seen the flash, stock price crashes this year. We've seen Google/Alphabet drop, and they're back up now to a pretty
170. Yeah, they
in the
had
170s.
Yeah, they've tipped up to the 180, getting closer to the 180s. But yeah, you've seen a lot of these stocks hit their lows. Right
UNH,
there.
United Health,
Yeah.
big turmoil with the news, but they've popped up about what, 20% since then?
Yep, that's right. SoFi's another example. They dropped down to what, $9 and change per share, and now they're back up into the 12s,
Back
even
up
as high as
40% right there.
yeah. So there are a
So
lot of opportunities for people in this market. I think that's what we were getting at. A lot of great buying opportunities. A lot of companies, if you can catch them at the low, you might be able to get some short-term gains and build that long-term income.
if you catch them at the top, you really shoot yourself in the nuts. No. But guys, all right, let's get the first one. We just talked about UNH, United Health, but we're talking about Elevance Health, ticker symbol ELV. I own it in my portfolio. Bert owns it in his stock portfolio. And ELV, again, in the insurance space, Anthem is their insurance carrier. Again, competitive to United Health. And I feel like this whole industry is getting taken down right now, but they are back to $372.27, which is pretty much at a break even ish point so far year to date, but that means they're down 29% from last year.
Yeah, over the last month, they've been at 413, as high as about over 420. They dipped once to 374 in the middle of May. And now at the end of May, they're right back to that point. They're at sorry, did I say, yeah, 374, and now they're at 372. So it's been quite the month. There's been a lot of whoop for Elevance Health.
Yeah, and hey, this is a dividend growth machine, guys. We'll get into it here. The PE is below 11 at 10.79x, very low competitive to the market, and reasonable and reasonably low compared to their competitors right now.
Yeah, that payout ratio is also very low too. That $6.84 dividend, their payout ratio is below 20% at 19.8. So very low, but in line with the sector of what you'd see.
Yeah, secure dividend. Obviously, even if earnings was cut in half, you'd still have a 40% dividend payout ratio. So they can keep increasing and paying the dividend because increasing the dividend is exactly what Elevance/Anthem does. 13-year growth streak, 5-year average is 16%. With the turmoil, probably expecting somewhere in the 5 to 10% range starting in 2026. But I guess we'll have to look at the financials over the next few quarters to see if that looks reasonable.
Yeah, well, we'll see. Yeah, it'll be an interesting year for healthcare stocks. That is for certain. With the stock dropping over the last 52 weeks, that yield is climbing up a little bit here, Lanny. That yield is at 1.84%. So it's closing in
Almost
on a
2%.
2%, which would be insane for a company like Elevance Health.
Oh, that would be nice. They're 84 billion, not a small company by any stretch of the means. That is Elevance, 10 to 11 PE, 20% payout, 16% growth rate, almost a 2% yield. I like them at these prices. Maybe I'll nibble here.
Yeah, I agree. I think it's at a great price now. And my God, if it gets to 2%, I can guarantee a 2% yield. I will at least be buying two shares of it at that price.
All right, Bert. Now, if you guys hadn't caught any of our option videos, Bert had an option on this stock at $130 stock price. Well, they had a bad earnings and that stock price went into the other direction. Guys, we are talking about the bullseye, the red card, the target, TGT, brother.
Yeah, they are down 31% in 2025. They are down 35% over the last 52 weeks. They're still a pretty fairly large company, though. They are $43 billion in market cap. So despite dropping down, Target's a pretty decently sized company.
Can they reinvent themselves is the question here. Obviously they have the cartwheel, the target deals, the red card.
Mhm.
They came out with their red card 360 or circle 360, which is their Walmart Plus, aka same day free shipping,
Cool.
whatnot.
Yeah.
Um,
They're like every
and
company now that has a subscription service.
Exactly, guys. So we'll have to see. Can they reinvent themselves, though? Because they've done it a few times, I would have to
Mhm.
say, in the
Yeah.
past.
So let's look at the metrics here. That price is 94.29. Earnings per share are 7.39. Gives you a P ratio of 12.76.
Pretty decent PE, obviously well below Amazon, well below Walmart, and more than likely, I don't know if you throw Kroger in here or not, but probably below Kroger's PE. So could be a value trap. But let's look at the dividend payout ratio, paying $4.48 spread over obviously 4 quarters, 60.62%. So right at that ceiling of that dividend payout ratio that we have.
That's actually lower than I was expecting it to be. I was expecting to see something in the 70 and 80% based on the news we've seen. It's good to see it's going to be at 60% because, as you said, if they're going to reinvent themselves, they're going to need some cash to do that. They're going to need to infuse some capital into the business. So it's good to see the payout ratio is not bumping up against 100.
It's very, very good. Now, if you look at their growth history on the dividend, guys, they're a dividend aristocrat. They are a dividend king. 56 years straight dividends, guys, of growing it without missing a beat, a 14% dividend growth rate on average. Oh, man.
Oh man, and this king is closing it on a 5% dividend yield, Lanny. A 5% dividend yield for Target. They're at 4.75 right now.
Yeah, I mean that's why it's like, hey, can you just get the yield now, lock in that yield on cost, and then just hopefully benefit in the future? I mean, again, down 31% this year, down 35% since last year, 43 billion. That is target stock. Bro, what's your take?
I mean it's definitely going to be a turnaround story. It's going to take some time, but it's
Can
crazy.
they do it?
Can they do it? I was at a Target this weekend picking some stuff up, still packed. So, at least in my suburb, I'm also in a suburb, like
Yeah, I went.
populated
I,
suburb. So,
yeah, I went. Yes, today's Sunday. Yeah, I went yesterday morning on a Saturday, and right when they opened, I was actually surprised that there were that many people in there at like 8:20 in the morning.
yeah,
Like, I'm like, what are you guys all doing in here?
yeah. I mean, so there's still people going there. It's not as if they're abandoned, but they have some work to do. Seeing them at a yield at 5% would be crazy. It'd be hard to not buy a couple of shares if their yield crosses 5%.
And we're not too far away. So that's Target stock. Again, not going to say recommend buying Target right now because it's just the retail factor, but again, if you're a loyal and you love Target, it's a good entry price, I would say. But let's get into that third stock, right, B?
Yeah. Pepsi, ticker symbol PEP. Talk about a company that
Oh,
everybody loves right now. This might be the most controversial dividend king out there.
oh, it's bad food, bad drinks. They're not gonna have this. They're not gonna sell a single product anymore.
Yeah. Pepsi's falling from the list. It's not the top pop. Oh no, what are we gonna do? It's not as if they don't have a massive snack division or a massive water division or a massive
I tell
water
you
product.
what, the number of people just crushing on Lay's chips still is insane. Not to mention all the other healthy brands. They have all the baked products that make it.
Yeah.
There's two ingredients, and I think the baked Lays. I think it's
Baked
potato
Lay's.
and
Okay.
vegetable oil, or and maybe three ingredients, maybe salt.
Yeah.
And again, it's
Yeah, I mean, I think that's the thing that people saying. Doritos are still crushing it, but they also have your Quaker Oats, your Gatorade, your Lipton. iced tea too. So they're obviously much more than just
Boppy.
Pepsi. Yeah, that is true. They just bought that, even though never had it, never heard of it before, but I'm going to trust the market on that one. So Tropicana as well. Like there's some other things there to keep Pepsi afloat in this time. The question is, how are they looking in the metrics right now that they're hanging at the price levels they are?
Let's dive in, guys. Again, down 14% this year, down 27% since last year. Trading at, yes, below 130 at 129.34. Both Bert and I were able to grab a share below 130, which was pretty awesome. $8 almost in forward EPS with a PE ratio of only 16 for Pepsi. Wow.
Very cheap for Pepsi. Let's check that yield though. That dividend is $5.69. That's a 71% payout ratio.
A little bit on the higher side. Reminds me again, I think you and I have talked Coke about 10 years ago, circa, where they just kept churning along at the 70 to 75% payout ratio.
Yes, you're right. Let's look at that dividend growth at 7.82% 5-year dividend growth rate. And I mentioned earlier they're a dividend king. They've increased that dividend for 52 consecutive years.
We got two kings on today's video, guys. Pretty awesome.
Hmm.
Similar to Target stock, the yield has now crept up to 4.40 freaking percent for PepsiCo. Oh my gosh.
Down 14% year to date, down 27% over the last 52 weeks. Lanny, what are your thoughts on Pepsi?
I like the price. It's a good price. I'm closing in on 100 shares. I think I might be like 20 away. Obviously, that's still a ton of capital, but this is a stock that I'd probably look to buy at the current price. I think between them and Elevance Health offer two of the best values right here on this.
Yeah, I would agree. So let's put the metrics up here again. The three stocks that might be too cheap to ignore: Elevance Health, Target, and Pepsi.
Gosh, bro, what are your favorites? How would you rank them?
I'd probably say Elevance, Pepsi, Target if I had to pick the three. What about you?
Yeah. Yeah, I can get behind that. Yeah, I agree. But the question is what do you guys think? What do you jabronis out there watching this video today? What do you guys think? Is Elevance better than Pepsi here? Is Pepsi better than Target? Is Target better than all of them? Let us know what you guys think is the best out of these three. If all three or one of the three, two out of the three are too cheap to ignore, are these stocks to buy right now? Let us know.
If you haven't already, subscribe to the channel. Give this video a thumbs up. And remember, you're either with us or you're against us, Jack.
That was Bert and Lanny from the gosh damn Dividend Diplomats, over and out.